All
All
right.
right,
So
folks, I got it, Jonathan. As promised,
uh,
in the school community, we are giving you access to more and more of the millionaires. This is unique access with content only available on school. Today's special guest is Mr. Jonathan Twombly. He's going to be going through a PowerPoint slide around market cycles, also giving us an opportunity to ask him questions, because again, something I strongly believe is the greatest transfer of wealth is in front of us. I think this is going to, at least in my world, be in the 5 to 50 unit buildings. So undoubtedly, we're going to ask him some questions about that. But Jonathan, the floor is yours.
Thank you. So once again, sorry for being a little late, but I want to take you through this presentation that's part of my program about market psychology. And it's something Michael and I have talked about for a long time, so I'm happy to finally be getting this in front of you guys. But what we're going to cover is a few things. We're going to talk about understanding the real estate market cycle. We're going to talk a little bit about quote unquote timing the market. And then the meat of it is going to really be about investor psychology through the market cycle, which is what I call market psychology. And if we have time, I want to leave time for Q&A. If we have time, we'll talk about number 4, but I think definitely the first 3. So what is the real estate market cycle? Okay, we'll just give us a pretty quick overview of this. But the real estate cycle was first detected by Dr. Glenn Mueller, who was a professor at the University of Economics at the University of Denver. He discovered it in the 1990s. And he publishes a quarterly report, which you can find online. These are the reports that I use in this discussion. I wanted to give credit where credit is due. This URL may be out of date, but if you Google Dr. Glenn Mueller market cycle, you ought to be able to find these market cycle reports. I think if you pay, you can get them currently. If not, they're free, but they're like a quarter or so behind. So basically, the market is, the way that he sets it out, the market is in 4 quadrants, right? You've got recovery, that's where you start, expansion, hyper supply, and recession. And so we're going to kind of go through each one of these individually. But first, you've got what's called the recovery phase, right? And that's kind of where we are now in some markets, or we're in recession in other markets. But the recovery phase is characterized by a number of things. So you've got oversupply from the previous new construction, or you've got declining demand, right? So those things put you back at the beginning of your cycle. Those are the characteristics of the cycle. Occupancy is at its lowest point in the cycle. That's number 1 right there. And where the market bottoms out is when the excess construction from the last cycle actually stops, right? So that's the new bottom. You've got a building phase, lots of construction, you get oversupply, but then when that construction ends, as it inevitably does because banks stop lending, that's when you're at the bottom. And as the bottom is passed, you've got no new supply coming to the market, but you've got now demand starting to grow, and that overhang of apartments, that glut of apartments is starting to be absorbed, right? You've got positive absorption again. You start climbing up this occupancy hill, right? As vacancy as vacancy goes down and occupancy goes up, rents stop declining, they start to stabilize. And then as your demand starts growing, owners are able to start raising rents again, but they're actually not able to raise them at the rate of inflation yet, but they are at least getting positive rent growth again. And this phase is over when the market reaches the long-term occupancy average, which you see at number 6 on the where that dotted line is. That's the long-term occupancy average. When the market hits that long-term occupancy average again, now rent growth is equal to inflation, and the market emerges from the recovery phase. After that, you're getting into expansion, right? So expansion is characterized by continued demand growth, which is creating the need for more apartments. And as the occupancy climbs over that dotted line past number 6, right, rents start rising pretty rapidly. And when that happens, that makes new construction feasible, right? So that's when banks start looking at this situation and say, aha, we'll lend again because look where rents are. Now, because of construction time, right, because it takes such a long time between, sort of permitting new apartments and then getting them constructed, right? Because of that, you have this lag. And during that lag, rents can really spike a lot, right? So as all these developers are kind of like gearing up to get ready to go, you've got this positive absorption, you've got the vacancy rate declining, rents are really growing fast. And you can have giant rent spikes during this time, really dramatically. And as long as the new demand that's coming into the market, so from population growth or population movement or whatever, as long as you've got that continuing, vacancy is going to keep dropping, rents are going to keep rising, and new construction is going to continue to be approved by lenders. The expansion period is typically slow and long, right? So expansions are long, contractions are rapid, but this will be a fairly long phase, and it ends at 11, at that point 11, when the new supply growth equals the new demand growth. And if you can sit at 11 for quite a while, it's not like you hit 11 and you suddenly drop. You can sit at the top of the cycle where new supply and new demand are matching each other for quite some time, right? So this phase can last a very long time. But eventually what happens is you go into hypersupply. And this is when all that pent up construction that's been in the pipeline for a really long time starts to hit the market, right? So when new supply growth exceeds new demand at point 11, that's when the market tips into hypersupply. And that's what we're seeing with a lot of the Sunbelt markets right now, where all that hyper rent growth for a long time pulled in so many developers, and everybody was looking at that demographic story and saying, wow, this is amazing, right? We're going to build. Well, they're all doing it at the same time. And this always happens. They overbuild. It really can't be avoided. There's no way to really stop it from happening. And you tip into hypersupply. So basically this happens because there was so much construction approved in phase 2 and so much comes online all at the same time that all this new supply exceeds new demand. And you start getting the occupancy trending back down towards the long-term average, right? Competition for tenants between these new build properties starts to really intensify. And actually what we've been seeing in this cycle is something that a lot of people didn't anticipate, but the Class A properties are now stealing from Class B, and Class B is stealing from Class C. They're all competing with each other as vacancy has trickled down. Now, rents are still rising at this point, which sounds a little counterintuitive because of this catch-up period, but they're starting, the rate of increase is slowing down, right? Now, the thing about this phase of the market is that most market participants don't recognize that the market has passed point 11 because they still have very high occupancy and they have high rent growth still, right? So rent growth is still positive because that supply is coming on, like it's trickling into the market, but it's slowly eroding the fundamentals, right? So nobody really knows it's happening, or they don't recognize it's happening kind of until it's too late. But the key to understanding that this part of the cycle is happening is that rent growth is slowing, right? So if the rate of rent growth is slowing, even though you still have rent growth, that's a signal that you're in the hypersupply phase. And if this continues, if new supply continues to exceed demand, then the market tips into phase 4. Now something that I want to point out is that this is not a one-way, even though this is set up as like a one-way track, or it's not one way. Like you can actually move backward on this, right? And so you can get into hypersupply, but go back into expansion if for some reason demand starts to exceed supply again for some reason. Like, so let's just say, I don't know what could happen, but like a huge new employer moves in suddenly to this market, right? And 10,000 jobs are created overnight. And now everybody's looking for, for a place to live. I'll give you an example. In upstate New York in World War II, the U.S. Army, actually the Navy, built a naval base on one of the Finger Lakes in New York, and suddenly brought 45,000 people into this naval base and like overwhelmed the market, right? So something like that could happen and make you go backwards, right, on the supply sort of curve. All right. Phase 4, recession. This is when occupancy drops below the long-term average, right? And because the new supply is continuing to come on the market and it's overwhelming demand, and the market goes into this recession phase, right? Now, this is where you really get into this competition game. Landlords start worrying about not only losing market share, but I mean, paying their debt, right? They start competing like crazy with other owners, offering concessions, lowering rents, and they'll basically continue lowering rents. They'll keep on going as low as they need to go to cover their fixed costs. So they'll actually get into, if things are really bad, you'll get into a situation where all the owners want to do is cover their taxes, insurance, and debt service, no profits at all, because they just want to avoid foreclosure. And we're actually seeing that in some markets right now. Now, during this phase of the market, what you see is that market liquidity is practically non-existent because owners asking prices and buyers bidding prices are way too far apart. We're actually, you can see that in real time right now, where it's almost impossible to sell a property, to sell out of this situation, because buyers just have much lower expectations for what they're willing to pay than sellers need to get. And the length of this phase is going to depend on how bad the overbuilding was and how long it takes to be absorbed by new demand. And then, you know, once finally all that new construction stops and it starts being absorbed, that's when you enter the new, the new cycle again at phase one. All right, so this is sort of like an overview of all of what I just said. So if you look at phase one, you've got negative rental growth, and below that, then you move into below inflation rental growth, right? Then you get, once you cross that long-term occupancy average, you start getting pretty rapidly rising rents, higher and higher rents as supply is catching up. In phase three, you've got still rent growth. It's positive, but it's decelerating. And then in phase four, you've got, below inflation rent growth moving into negative rent growth. And then the whole thing starts again. All right, so let's talk a little bit about timing the market. Okay, so no one can absolutely time the top or the bottom of the market, and you'd be foolish to really try to time the market, because you can never really understand exactly where on those 16 points of the cycle you are. However, it is possible to understand kind of roughly where you are in the cycle, and generally speaking, to understand whether it's better to be buying or better to be selling. And Michael and I, if you follow this channel, Michael and I have been talking about this like ad nauseum for years, about whether it's better to be buying or selling at a particular time. And the kind of analysis you want to be doing is, when you feel that the chances of the market rising exceeds the chances of the market falling, then you should buy, right? So right now you can't time the bottom, but if you feel like, hey, yeah, there might be a way to go before we hit bottom, but if my hold period's 5 years and I believe that the market's going to be higher in 5 years than it is now, then, you should buy, okay? Similarly, if you think that the market is going to fall, if you think that the chances of it falling exceeds the chances of it continuing to rise, then that's a good time to sell. So, I want to kind of now explain sort of what's going on with cap rates throughout all this process, right? So you've got your four quadrants here. Now, in this upward phase, you've got cap rates are falling and prices are rising as you go up the cycle, right, from 1 to 11. That's, so you just see, prices are going up and up and up, cap rates are getting more and more compressed. But what I think a lot of people don't really recognize about this is that your risk is also rising during this phase, right? Now, it may not be very high risk at the bottom, and even sort of towards the middle of this, but you have to recognize that, and we'll get into this when we talk about psychology, that the typical investor sees the market going up and they think, oh, goody, I got to get in. I think a more sophisticated investor looks at this and says, okay, I've got to be cautious because the risk is rising as these prices are going up. And the same thing happens on the way down, right? On the down part of the cycle, the prices are falling and cap rates are expanding, but your risk is also falling all this time, right? So you have to just take this into consideration. All right. So this area here obviously then presents the highest risk for buying, and this area presents the lowest risk for buying, generally speaking, okay? Now, as I said, you can't perfectly time the market, but you should think about it in terms of being either a net seller or a net buyer, right? A net seller, you're selling more properties than you're buying. A net buyer, you're buying more properties than you're selling, right? When do you want to be a net buyer? Well, when occupancies are below their long-term average, right, for that asset class, right? That sounds a little counterintuitive, but if you think about it, if occupancies are below their long-term average, that means there's only one way for them to go. They're going to go up. And that means you're going to be buying into a market where you're going to be getting cap rate compression, meaning cap rates are getting smaller, which is what you want. And if cap rates are above their long-term average for that asset class, then you should be a bit more wary, right? Because, they may stay above, they may stay above the market average, the long-term average for a while, right? But you really got to think about, well, how much runway do you think you have? When should you be a net seller? Right? When occupancies are above their long-term average, right? So when things are doing really, really well for a very long time, you start thinking about the risk that's building up. And at the same time, when cap rates are below their long-term average, right? Meaning that they're low, prices are high. This is, when you want to be selling. Cap rates are compressed. You're going to get a really great price for your asset. This is when you should be selling. All right. So this is kind of review, but you want to be a net buyer in phase one, right? You've got above average cap rates, but they're falling. You still want to be like early in phase two, a net buyer. You've still got below average cap rates and they're still falling. So you're still getting compression. As it goes into phase three, you've got below average cap rates, but they're starting to rise, which means decompression. That's, when you want to be buying strategically. If something amazing falls into your lap, but generally you want to be cautious in this period. And in this final recession phase, you've got above average cap rates and they're very rapidly rising, which means decompressing. It's going to be very hard to find deals, but it's going to be very hard to find deals, but if you can, you want to buy. The problem is there's very little liquidity here because of the bid-ask spread.
Hey, Jonathan, real quick.
Yeah.
I want to jump in here. Folks, over the last, 3 or 4 days, you've heard me talk about an apartment building that I owned in 2019. I want to take that story and kind of put it on this chart for you so you can see the importance of understanding your market and, of course, what we talk about, the buy box. So in 2019, my market, obviously, Central Valley, California, the historical cap rates were about 8.5% for Class C apartment buildings. At that time in 2019, they had fallen to somewhere in the fives, which is way below normal by, several standard deviations. So of course, what did I do? I sold it. And I've done the rough math for you from memory. I had 100 grand in NOI at an 8 cap or whatever it was with 1.25. It goes down to a 5. It's suddenly worth 2 million. I sell. That person gets a $1.5 million loan, 25% down. That then, over time, it reverts to the mean and maybe it goes back to a 9 cap because it always goes to the other side. This is real pain. This stuff really happens. This chart here that Jonathan is going through, it happens. You have to pay attention. You have to be in the market. And to be clear, I sold the building at what I thought was a 10 or 11 on this chart. Little did I know the pandemic would come and they would go from a 5.5 to a 4.5. But, that's just more craziness. I'm glad I was out. But we bought that building at a 16 or a 1 on this slide in the last cycle. So please, the buy box that we talk about every day, it plays in multifamily as well. So again, this chart, this is how Olivia and I, made. And again, the other thing I want to point out that very few people talk about, in my opinion, single family and multifamily, in this case, talking 5 to 50, anything over 5, they're different cycles. So if you read our book, One Rental at a Time, Olivia and I sold houses at an 11 on this slide, and we 1031 into multifamily, which is probably a 14 or a 15 on this slide. So we were moving equity. We got out early. So again, please understand the buy box. It plays in multifamily as well. Sorry, Jonathan, go ahead.
That's okay. That's okay. So, so the next piece of this is sort of market cycles part 2. And and I apologize for really rushing. I just really want to try to get through all this. But I want to talk here about investor psychology through that cycle that we just talked about. Okay. So I call this market psychology. It's a little, play on words that I thought was cute, but, sort of reviewing where we were before, you've got prices going up during this expansion phase, right? And risk going up as well, right? And I want to talk about, well, let's see. Let me sort of back up. So there's a when you look at this here, right? When I lay it out in this chart, you think, well, this is obvious, right? Prices are going up, you're moving up the cycle, it's getting more risky, right? But it's not really how people think. Like, there's a great quote from Warren Buffett, which says, most people get interested in stocks when everybody else is interested in stocks. The time to get interested in stocks is when nobody else is interested, because you can't buy what's popular and do well. But most people, what they do is they buy, what's popular. So, you would think that seeing this, most people would start to feel cautious, but in fact, the exact opposite happens. And this is because of herd mentality and trend chasing. Now, I actually do a whole sort of also cover psychological biases and stuff in my program, but basically herd mentality and trend chasing are two biases that people have that tend to make them like just do what everybody else is doing, right? So what you find is that a lot of investors get more aggressive the more prices and the more prices are rising, even though the more that risk is rising, because they feel it's less risky because everybody else is doing the same thing. Now, usually what you see through the market cycle is the first investors who get in are the most sophisticated. That's like Michael, right? They're the most sophisticated, the most aggressive, and they have the best understanding of market cycles. This is otherwise known as the smart money. When you hear about the smart money, this is what people are talking about. The people who are willing to do the opposite of what the crowd is doing because they know the crowd is dumb, essentially, right? So they get in early when the prices are most attractive and they make the most money with the least risk. However, most investors, right, are scared and cautious after a correction, right? When they hear about a correction, it just makes them afraid. Rather than getting aggressive and gleeful, as they should, they get really scared because, oh my God, what if I lose money because I saw these other people losing money, right? So they wait and they see do what everybody else is doing, right? And if they're looking around and most people are out, so they stay out, right? So they basically like are chasing a money-making trend that's actually over by the time they even get in or by the time they even hear about it, right? Because most people are on the sidelines waiting to see what everyone else is going to do. And by the time they hear about people making money, well, the money's already been made, right? And what happens as you go through this cycle and you climb up, the market pulls in more and more cautious investors, right? So the more cautious you are, the more likely you are to get in at the top because you're waiting to see what everybody else is doing. And that those profits, you start hearing about it, and that FOMO starts eating at you. And this is the kind of like, that Joe Kennedy shoeshine, stock market tip thing, right? When you start hearing everybody talking about it, or when Michael talks about he went to a meetup and everybody was a syndicator, like he knew now's the time to get out because so many people have been pulled in. And kind of sadly, the people who get hurt are the most cautious and most risk-averse investors because they're the ones who are pulled in last when the market is at its most risky. And so on a market psychology basis, the market top is when everybody's doing it, right? When everybody has real estate investing on their minds and interest is highest. And I don't know how many people are old enough to remember this, but like at the top of the bubble in the great financial crisis, every TV show was about flipping, right? Every TV show was about flipping. And when that's like where the culture is at, it's not going up much further, right? This is the point where it's very, very difficult to make money and the risks are highest because there's so much competition. And this is what Warren Buffett is talking about when about that quote I just mentioned. Most people get interested in an investment when everyone else is. The time to get interested is when no one else is. You can't buy what's popular and do well. Now, we can look at this again, back to this chart again, right? As the early on, who's getting in when, right? Well, the most sophisticated people are getting in that recovery phase. And the most, as you climb and climb and climb, you get more inexperienced investors coming in, right? People with no sort of long-term memory, just as that risk is climbing, right? So the early smart money is getting in down here, right? And the cautious investors are getting in at the top after they've seen everybody making money. And guess what's happening? Who's selling to whom? Well, that early smart melder, they're selling to those guys, right? The guys who got in, well, who's going to buy? It's all those overeager, inexperienced, nothing could possibly go wrong. It's all good news all the time kind of investors at the top. However, it is also sort of a little bit contrary to what I just said. It's not just new and experienced investors who are buying at the top, because greed and herd mentality are extremely powerful emotions. And many professional institutional buyers continue to buy at this point because they're suffering from confirmation bias, right? They're basically ignoring all the evidence that the market's overpriced, or that the economy is weakening, or that there's new supply coming on. They only focus on the good economic news or the arguments why the rally will continue. This is when you start hearing, people dismissing any negative news or arguing why it doesn't matter. You hear there's a new paradigm. The Fed can't allow a crash to occur. This time is different. This is all the stuff that you hear at the top, and you'll hear it from people who are, should know better. A lot of like institutional buyers, and you'll also hear, and I remember this at the last, sort of the top, people will start saying stuff like, well, BlackRock is buying, or, JP Morgan is buying, or whoever else. Those guys are smart. And they've kind of like abdicate all of their, their own like analysis to someone that they think is more experienced, when most likely, these people are just those BlackRocks of the world. They've got so much money being funneled to them that they just have to put it out, and they don't even care. They're not making decisions based on the best time to buy. They're just looking for fees. So when you hear these things, these are signals to you that the marketplace is becoming very complacent, and it's really the time to be the most cautious. And the thing that you need to remember is that crashes and corrections occur at the top of the market, not the bottom, right? This sounds self-evident, right? And you can't tell where the top is until after the crash happens. But what most people, when you talk with like your average investor, the time when they're most worried about a crash is after a crash has just happened. And that's not when crashes happen. You don't get a crash after a crash. You only get a crash when the market has peaked, right? So keep that in mind, right? Now, you'll see this in reverse as well, right? When prices are falling because of a lack of liquidity or because of a lot of foreclosures, you get risk falling, right? And what happens is at this point, this should say late sellers. You've got late sellers. They want to sell, but they can't, right? Because liquidity is gone. The buyers are not willing to offer them what they want. You've got people starting to panic at this point. They will look to sell, pretty much for any price, right? They just want to get out, right? And, they start selling to the smart money, right? What you'll often see, and I find this crazy, you'll see, so the psychology of sellers who miss the moment to sell is, sometimes they'll be underwater. And basically the stress of that is so great that the minute their property, they'll hold on for dear life until that point where the property is just above water again, and they can get their equity out, and they sell right there, then and there, right? It's so dumb. The market's rising now. Just hold the property, right? Why would you got to sell it and then go buy something else? I mean, if you can survive that trough, just hold it. You'll be fine. But you see a lot of people sort of panic selling the minute they can in that phase one recovery. So you see like these late buyers finally being able to sell right at that point at about number 6, maybe, and they're just getting out, as soon as they can. So another way to think about this, just a little more anecdotally, if you think about Warren Buffett and John Templeton, these are two of the world's greatest investors, not real estate, obviously, but, they have the same idea here, which is, Warren Buffett says his secret to massive success in real estate investing is we simply attempt to be fearful when others are greedy, and to be greedy when others are fearful, right? And Sir John Templeton says the same thing. He says, the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. So in the context of real estate, just to recap, occupancies rising above their long-term average will cause investors to become very greedy, driving cap rates down. This is the time of maximum optimism. This is when you should start to become fearful and stop buying or consider selling or just be very cautious about what you're buying. When you've got occupancies the other way, falling below their long-term average, this is going to cause investors to become very scared. It's going to cause cap rates to go up. This is the time of maximum pessimism. And this is when you should start really be, thinking in greedy terms. So just to sort of recap there, at point one, you've got minimum enthusiasm, minimum risk, maximum reward. You've got above average cap rates, but they're starting to compress. In phase two, you've got below average cap rates, and they're still falling. But then you hit point 11. This is maximum enthusiasm, maximum risk, and minimum reward, but this is when most people are getting into the market. At phase three, you've got still above average cap rates, and they're slightly decompressing. So you've already had some decompression, and there's getting more decompression, so people are getting more panicked. And finally, the last phase, you've got below average cap rates because they're starting to compress, and they're very rapidly rising. I'm sorry, it looks like I made a mistake there. So you should have still above average cap rates in phase four, and they're still decompressing. So I'm sorry to mix that up in the presentation. So I think I'll stop here. Yeah, I'm going to stop here.
Yeah, stop there. We'll get to questions in the comments in a minute. I just want people to realize, kind of take this picture here with what I'm bringing up in the daily financial news and other conversations. I believe Class A stuff is starting to trade. So we're starting to see that cap rate expansion. We're starting to see people who have to get out. So in my opinion, Class A is, past 11. You can argue if it's a 13, 14, whatever. It's probably different based on city, buy box, all of that. But what I want this audience to hear is I am fairly confident that Class B and Class C has not started to trade. So we are still, in that weird moment. We could still be at an 11. And, we won't know for a while. I think Class B and Class C have plenty of pain ahead. So if you're shopping like I am, and you find a seller who is feeling pain, realize it might be early. It might be early. So again, my whole notion of aggressive offers or disrespectful or whatever you want to call them, don't, quote unquote, catch a falling knife. These cycles take time. These are not stocks. They don't move in minutes. They move in quarters. So keep doing the work, understand what you're looking at, understand your city, your buy boxes. And again, this chart plays for single family homes as well, even though Jonathan is talking big multifamily. So let's go to some comments or chats, I guess. Jonathan, I'm going to read a couple of these for you.
Sure.
Let me just go back. Hyper supply is everywhere around me at the moment. I have 5 Class A apartment properties in Richmond, Virginia, with new incentives of $300 to $500 off rents a month for the first quarter. Rents have been around $2,000 a month for 3 bedrooms. So talk about Class A coming on market, Class A delivering rent incentives to fill up. Jonathan, it's very common behavior.
Yeah. So what's the question exactly? I'm not really sure. So,
I think what I would highlight this is with this chart. Where would you think, Rich, again, just given what lots of stuff coming online, having to give rent incentives, where are they on this chart?
They're definitely guess. They're in phase 4 for sure. If they're offering concessions, especially large concessions like that, they're definitely deep in phase 4. So 15 or 16, and properties like that are probably in jeopardy of foreclosure. If they're,
because what you probably have is an owner or operator or team that is frankly desperate.
Yeah, because there's so much new supply that's come on at the same time. Now, if they're able to ride it out and just survive, then I know in some markets, I don't know about Richmond in particular, but I know,
Sure. Yeah.
nationwide that we had positive rent growth as nationwide for the first time in several years last quarter. So, or last month. So that means that in some markets, it's starting, the demand has caught up with supply, but there's still a bunch of markets that are oversupplied. And it's going to be a while for them to start that absorption cycle again. And this is what you see in every cycle. You'll see
Yep.
the stuff that just gets delivered too late to stabilize. The timing is bad, and those are the properties that get foreclosed on, and somebody buys a really nice new, Class A property for probably below construction cost
Yep.
and does great. But
Well,
unfortunately,
yeah,
the
let's be
developer,
really clear. This is what Ken McElroy has told us he's doing, right? He's trying to operate in Class A. He's trying to be a speedboat around battleships, and he's being very aggressive right now. He's trying to find buildings that are in this shape because he can buy it, put in the right debt, be the operator, and wait for it to turn around.
yeah.
He's doing this. Ken McElroy is playing right now because he thinks it's 15 and 16, at least in some markets.
So
That's
if you
what
have
he's saying.
cash, if you have cash, right? And it's going to take cash to do these deals.
Oh yeah, yes.
Because either, but if you have the cash to what most of these developers and syndicators are concerned about right now is, well, their best case scenario, and honestly, this is their best case. Best case scenario is breaking even and getting their equity out, right? So making their investors whole is their best case scenario. But a lot of them are realistically looking at wiping out either some or all of their investors' equity and, just hoping to break even on the debt so they don't get foreclosed on, because if they get foreclosed on, then it becomes really hard to get debt in the future. So
Correct.
they're trying to just play. So if you've got the cash to come in and basically buy it for the cost of the debt, right? Or just take over the debt, then you're going to be in really good shape. And you'll be able to buy a lot of these deals. The problem is it's going to take, that's like it takes a long time for these sponsors to get to that point psychologically where they're ready to throw in the towel and just say, okay, my equity is going to get wiped out. I'm going to hear it from my investors. This is not going to be fun, but it's better
it's
than
coming.
Yeah.
It's coming for some operators in some cities. You and I've been warning. We turned $100 million building into 48 million. We told people we did our job. But again, I want people to realize there are people that are looking at this opportunity and shopping right now. I guess I have one more question, just giving timing. We're going to go to the chat again is, Jonathan, how do you source deals and what makes a property attractive to you?
Well, I mean, I guess it depends on what you mean by like what kind of properties you're looking at, right? But I would say as a general matter, I source deals from brokers. Like I don't mess around trying to like
You're
send
not doing
out,
direct to seller?
there are people who do this in multifamily, but I talk with I have a group of syndicators I talk with every month. We've been talking every month since 2016. These guys, between us, there's like 8 people in the group. I mean, there's got to be at least $1 billion of experience in that group, if not more. None of them is sending out letters. That's not how they operate. A couple of them have hired like VAs who do nothing but reach
cold
out
call.
to, but cold call. But for the most part, people are dealing with brokers. And once you kind of get a reputation for closing deals in a certain market, brokers will start bringing you the off-market stuff or the quietly marketed stuff. I don't think it's really worth the effort to try to go direct.
Well, we've only got a couple of minutes. Let's go to part B of that question. When a broker brings you an opportunity today, what do you see in the numbers? What do you see in the opportunity that causes you to go, oof, I have to dig deeper?
Yeah, I mean, it's the ability to generate a return approaching 20% to my investors. That's what I'm looking for. Because I think investors, and especially right now, given everything that's happening, if you're not getting pretty close to 20% on an annualized basis on a 5-year hold for your investors, there's not going to be a lot of interest. And I mean, that's always what I've shot for, which made it really hard
Yeah.
at the top of the market. But and that, that means that's net to the investors. I get paid too, right? So
Yep.
it's got to be a pretty good deal at a good basis. So what I'm looking for now is, I'm looking for stuff that's kind of a little distressed, like things where I can buy for a really low basis, maybe stuff that's been sitting on the market for a long time. I mean, especially in the hotel space, as you guys know, I'm kind of been doing a lot of stuff in that market these days. Um, just looking for situations where I can get this thing cheap and go in at cheap, because at the end of the day, you make money on the buy. I mean,
Correct.
that
Yeah.
saying went out of fashion for a long time when it became impossible to find deals that were priced well, but you just can't get around it. A low basis will cover a
Mhm.
whole lot of other sins. So
Absolutely.
yeah.
Well, Jonathan, you are amazing. Thank you for doing this for us. We appreciate you being on the show weekly. We appreciate you doing this for the school community. If somebody wanted to reach out and follow you, how do they do that?
Yeah, you should come follow me on LinkedIn. Connect with me there. I'm happy to chat with you guys. And if you're interested in learning more about multifamily, I also have a school group called Apartment Investors Club. So just look us up on school and you can join there if you want.
Awesome, buddy. Thank you so much, guys. Take care. Remember, the next session will be Saturday morning, 8:30 inside school, where we're going to have one of our school students interview me. See you guys there. Take care. Later.